The quiet, to me, signals something. We have the artificiality of negative yields. We have some new definition of the zero bound. We've got Japan and true gridlock and fixed income linked together, this odd economics to the quiet within the bond market.
Well, on the one hand, you have really all the central banks for many decades now pushing down towards the zero interest rates and very much wanting to keep them there. And on the other hand, you have inflation suddenly appearing for the first time in, really over a decade. And it seems undeniable, and it seems as if it's becoming more widespread. So it's a lull before the storm, before the Fed in particular needs to act and do something.
Well, the Fed's going to need to act and do something. Are you predicting they are? There's a lot of people out there, let's go with the ancient term inflationista, saying we will see price down, yield up. Are you managing for that outcome?
Only in the sense that in my fixed income holdings, I've gravitated over the last couple years actually to better quality because they won't be as badly impacted if we have a move up in Treasury rates.
Margie, is the quiet because there really is nothing going on, or is it simply because right now the bond purchases are overwhelming market reactions, market pricing that would normally take place?
Well, yes, we have the Fed meeting. We also have the quiet before the budget resolution to raise a debt limit. That's a real hurdle. Nothing is going to happen before then. And most people, I think, are now expecting the Fed to do something in the way of tapering. And it's interesting. We all know they're going to do it, so it should all be priced in the marketplace. But when they begin to do something, it'll be interesting to see if the market has a surprise after all.
I guess, Margie, what I'm trying to ask is, what is the direct effect on markets of the $120 billion monthly bond purchases by the Federal Reserve? Is there a direct price reaction in the market as a response from this that will change directly, not from signaling, but directly when they start to reduce that amount?
Well, I think if they reduce the amount of mortgage purchases, that would be the most important factor because I think the Fed's actions of basically just hoovering up all the mortgage securities has kept mortgage rates maybe even artificially low. So if they stop buying as many mortgages, would that cause the mortgage rate financing for homeowners to actually go up? Again, that would not be what the Fed would want to see, but they may not have a choice. So that's what I'm thinking would be something that I'm going to watch and how the banks react to if they reduce the mortgage purchases.
Margie, one thing that we've been talking about this week on this incredibly exciting week for price action has been the incredible divergence in the potential views for the economic outlook going forward, and how that's one aspect. John keeps repeating this. Tell him where that is, and then tell him where the prices are. It's sort of unclear. How do you sort of game out this dramatic uncertainty in economic outlooks going forward when it comes to a market call?
Well, it looks as if the market itself, the economy, is very, very solid grounds. It looks as if all sectors are really moving. The only problem is higher prices for inputs and shortage of labor, and those aren't really bad problems to have. And corporations aren't over-levered, consumers aren't over-levered. So it looks like the economy is in great shape and should be able to take the market higher. It's just a question of how does it react to when the Fed begins to tippy-toe and do something for tapering.
Margie, we had on Anna Hahn of Wells Fargo the other day. I don't know if you read her literature. She's just brilliant, Yale physics, and just really gets it done. I was thunderstruck by the concision of the Wells Fargo equity team on modeling together an earnings call with multiple compression to optimism now and relative optimism out a year, if anybody can look out that far. Do you share that confidence of concision that we see off your equity desk?
I don't know if I have the confidence, but I also believe that. I think that we should see price-earnings ratios stay the same or get compressed, even though earnings are rising up. So that would leave the market still able to move ahead for those companies that have sustainable earnings. So I think that says the market should move up, even if it's more modest than we've had over the last year, and more widespread, not just a handful of stocks lately that have driven the market over the last, say, 6 months.
Is Microsoft a one-off, or do you see continued use of cash for share buyback over and above options?
Companies, I think, have way more cash than they can deploy, and it depends a little bit on what kind of a tax bill. Will that change their behavior, whether they pay dividends, buy back stock, or make acquisitions? So again, we have to see how they react, but they have lots of cash to do whatever they want.
Margie, when you came on the show earlier, you said that we have seen the death of the credit cycle as we know it based on the response that we have seen from policymakers. And I do wonder, if that's the case, why not just invest in the absolute riskiest debt securities and then make a call on some of these interest rate sensitive stocks like Microsoft, thinking that they will be supported by these low yield policies for the foreseeable future?
Well, I think the riskiest parts of the market are priced with very, very little premium for anything to go wrong. If there's a hiccup in the economy or too much inflation or the Fed overreacts, that's a sector that will be impacted. We've had a tremendous amount of financing from the bottom tier, particularly, say, in the loan market, private equity market. Those are the weak parts. Plus, emerging markets, always my candidate for when markets start to crumble.
Can you play EM now? I mean, which way do you play EM? You mentioned the crumble word. We don't talk crumble on Friday, Margie, but go ahead.
Well, I think there's more reason to be cautious. We've seen China's growth decelerate. We've seen some cracks in the financial system with a large real estate developing firm look as if it's going to need some kind of restructuring. And that's really negative for all emerging markets, I think. And so I think that that's an area that I'm still a little cautious out. There hasn't been much risk premium. I think the U.S. still looks like the best place. We should have the growth. Also, continental Europe doesn't look bad. They should have 2 or 3% real growth. So that's not bad.